Welcome to Third Decade Class 5. In this class, we will start learning basic vocabulary and key concepts related to investing. We'll begin by learning about different kinds of financial assets. In the next two classes, we will grow your investing confidence by helping you understand how to manage investing risk and how to make use of various tax-advantaged retirement savings accounts. Here are the learning goals for Class 5. As usual, you will take a short quiz after class related to these learning objectives. You will also see items assessing these goals on the end of program exam. On the next slide, we'll ask you to think back to what you learned about the Magnificent Seven, our foundational principles, in order to answer a question. As an investor, you will face risk. The graphic illustrates the positive or direct relationship between risk and potential reward or returns. At the base of the pyramid are savings accounts, which are low risk. They are typically federally insured, but they're also low reward. As you move to stocks, the risk increases, but so does the potential for returns. Keep this in mind as we learn about different types of financial assets. An asset, of course, is something that has value. While both physical and financial assets may be included in your investment portfolio, we will limit our focus in this class to financial assets. These assets are intangible in that they largely take the form of transactions and written agreements that give you legal claim to something whose value may or may not fluctuate over time. On the next slide, you will see several examples of financial assets. When you hear me talk about returns or a rate of return, what I'm referring to is the performance of an asset and how the value of the asset has changed. If the rate of return is negative, the asset has lost value. If the rate of return is positive, the asset has increased in value. Positive returns represent income earned on an investment, and that income can come in different forms. You can earn interest on savings account balances or certificates of deposit. Certificates of deposit, or CDs more informally, are savings accounts where you can earn slightly more interest by agreeing to limit your access to the account balance for a specified window of time. You can also earn interest on bonds. Most of your long-term investing income, however, will be focused on stocks or collections of stocks in mutual funds or exchange-traded funds, where your income will be earned in the form of appreciation, the increased value of the stock over time, and dividend payments. We'll talk more about dividends shortly. In a moment, we're going to ask you to use the knowledge you currently have to make some predictions about different kinds of financial assets. This task will require you to be clear about the three terms defined on this slide. We've already touched briefly on rate of return, which is your income on an asset expressed as a percentage of the investment's value at the time of your purchase. Risk is the probability of loss in connection with an investment. In keeping with the maximize value principle from the Magnificent Seven, we want you to be well informed about the costs associated with your financial assets. Investing in financial assets is not free, so we want you to remember to examine fees and other kinds of expenses when making investing decisions. On the next slide, you will make some predictions about several different financial assets. You're going to use a 1 to 5 scale where 1 indicates very low and 5 indicates very high. Using this scale, you're going to make predictions about how different assets perform on rate of return, risk, and costs. One financial asset, cash, has already been completed as a model. So, for example, on rate of return, cash is rated at a 1 because you don't earn any return on cash. In terms of risk, cash probably rates a 2 because there is a chance it could be stolen, and inflation erodes the purchasing power of cash over time. Note, for some cells in the table, a range of ratings such as 3 to 4 probably makes sense, but you will only be able to select a single rating. Don't worry about that. For assets with which you are less familiar, just make your best guess. You may want to take a picture of your initial predictions on the next slide so that you can compare your predictions to the solution we will show you later in this class. Of the financial assets we'll explore in this class, I expect stocks to be most familiar to you, as they are more often featured in the news, pop culture, and casual conversation. When you buy a company's stock, you essentially become a partial owner of the firm. You have a claim on the company's profits and increase in value over time. Of course, profits and appreciation are not guaranteed. Some firms go out of business, in which case the value of the stock can drop to $0. If you earn income on a stock, it will come in the form of appreciation, that is, you can sell the stock for more than your purchase price, and or dividends. Keep in mind that if you see the value of your retirement savings account increasing because the stocks you own, likely through mutual funds, are increasing in value, you don't actually realize those earnings until you sell the asset. Some stocks pay dividends on a quarterly basis. In this case, a share of the company's profits are sent out to shareholders. Many people own stocks through mutual funds and don't actually see those dividend checks because those funds are automatically reinvested. There are costs to investing in stocks beyond the price of the stock itself. A variety of fees may be charged by the firm that assists you in the process of buying and or selling stocks. Buying an individual stock comes with more risk than buying the other kinds of assets we'll discuss in this class, but risk varies significantly across stocks. Market capitalization, or market cap as it's informally known, is one indicator of risk. It is the dollar value of the firm computed by multiplying the current stock price by the number of outstanding shares. In this class, we will limit ourselves to two major categories of stocks, large cap and small cap stocks, also sometimes referred to as income stocks and growth or blue chip stocks, respectively. Large cap stocks, as you might expect, are shares of very large companies, firms that have a market capitalization of $10 billion or more. Examples include Apple, ExxonMobil, Johnson & Johnson. Stock in these large, well-established companies will be somewhat less risky because the companies are quite stable. It also means there's probably somewhat less room for dramatic increases in value. Small cap stocks are shares in smaller, sometimes newer companies that have a smaller market capitalization, somewhere in the range of $300 million to $2 billion. Some examples of companies whose stocks fall into this category are Redfin, Groupon, and GoPro. Stock in these firms may be somewhat riskier than large cap stocks, but also may hold promise of higher returns. We can even break stocks down into a number of other market capitalization categories such as microcap and nanocap, but for now it's really enough to make the large cap, small cap distinctions to help us think about the relationship between risk and return. A common misconception among newer investors relates to the seller of stocks. Most of the time, when an investor buys stock in a company, they are buying those shares not from the company itself, but from another investor who is selling shares they bought at some point in the past. The exception to this is when a company first goes public or when a company issues additional shares. This will be an important thing to remember when we learn about overconfidence and the efficient market hypothesis in an upcoming class. Take a moment to study this graphic explaining bonds. Start with the investor on the left and follow the arrows to learn more about bonds as a financial asset. Bonds may be somewhat less familiar to new investors. You may recall learning about the U.S. selling government bonds to raise money during times of war. The government was borrowing money by issuing bonds, so that's what a bond is, a debt instrument. Governments, corporations, cities, school districts, and other entities borrow money by selling bonds to the public. When you buy a bond, you are acting as a lender. You are giving money to the bond issuer in return for a promise that you will be repaid your initial investment, your principal, plus some amount of interest. As an asset class, bonds are generally less risky than stocks because when an organization fails, say a corporation goes out of business, its first financial obligation is to bondholders, not shareholders. There is a measure of legal protection for your repayment, even if it's pennies on the dollar. Now, you should know there are many different kinds of bonds, and some, like junk bonds or high-yield bonds, are high risk. It's just that, as an overall asset class, bonds are usually less risky than stocks. As with buying stocks, you may pay commissions and other fees when buying and selling bonds. Higher quality bonds, like those issued by the U.S. government or other organizations that have a strong track record of meeting debt obligations, are low risk, and given that, will pay a lower rate of interest. The same is true for bonds with shorter terms. Bonds issued by less financially reputable governments and firms, and those issued for a long term, say 30 years, will pay a higher rate of interest. That's because the only way to entice investors to take on the additional risk is to offer a higher return. Bonds will probably be a small portion of your investment portfolio as a young person with a long time horizon. But as you age and the time when you might begin drawing income from your investments approaches, you will almost certainly adjust your asset mix so that bonds are a larger portion of your portfolio. We've taken a quick look at stocks and bonds, but now we're going to spend a bit more time on mutual funds for two reasons. First, they are the most common financial instrument used by typical investors to invest for the long run. And second, they are not terribly well understood by many investors. There are many individuals who own shares of mutual funds but don't realize they're investing in mutual funds. They know they are putting money in a 401k or an IRA, but they are often unaware that their contributions are being used to buy shares in mutual funds. The returns you earn on shares of mutual funds you own will come in the form of interest, appreciation, and/or dividends depending on the fund's portfolio. If it's a mutual fund filled with bonds, your earnings will take the form of interest. There are costs associated with investing in mutual funds. You'll pay a fee to cover the fund's administrative costs. Look for the expense ratio. And you may be charged other fees when you buy and sell mutual fund shares. The risk of a given mutual fund depends on the assets in its portfolio. A mutual fund with a portfolio of mostly large cap stocks would be less risky than one with a portfolio of only small cap stocks. On the next slide, you'll be linked to a video that will provide a helpful introduction to mutual funds. Pay close attention because as soon as the video ends, we'll present you with a series of statements about mutual funds, and you will be asked to identify which of those statements are true.
This is the Mutual Fund Factory, where all the world's mutual funds are produced. Fund elves wrap stardust, lemon drops, and a nickel in a unicorn bladder, which is then delivered via dragon sled to brokerage firms, who sell them to customers. The customer buries the mutual fund in their backyard, and after 30 or 40 years, a money tree starts blossoming just in time for retirement.
Babe, that's not remotely true.
I know, but we have to get people excited about mutual funds somehow. They're an important option in saving for retirement, and most people don't even know what they are. Even some people who own them, like in their 401ks.
Wait, 401ks are mutual funds?
No, not exactly. Let's start at the beginning. A mutual fund is kind of like a bowl of investment stew. Thousands or even millions of investors pool their money to buy a variety of investments, primarily stocks, bonds, and currencies, which are blended together and then divided amongst the participants. And just like a restaurant serves a lot of different dishes, mutual funds come in a lot of different flavors.
Some funds focus on a specific sector of the economy, like technology, retail, or agriculture. Others focus on specific areas of the world. Emerging markets refers to developing nations. And some focus on the size of the companies, from large cap to micro cap. And they can get a lot more customized than that. The Pax World Global Women's Equality Fund invests in companies that advance the cause of gender equality. Or, for something completely different, the Vice Fund focuses on tobacco, alcohol, gaming, and weapons companies.
Mutual fund shares are usually inexpensive, and you get the advantage of diversification without having to buy hundreds or thousands of shares yourself. But there are costs. Every mutual fund has an upkeep fee called an annual expense ratio, which ranges from 0.1 to 2% of the value per year. Some funds also charge an extra fee called a load when you buy or sell your shares, usually between 1% and 5.75% of the sales price. You can think of these fees as payment to the chef who whipped up your dinner.
Wait, who are these chefs anyway, and how are they deciding what ingredients to use?
Well, that depends on whether your mutual fund is actively or passively managed. Active funds are managed by a team of analysts and traders. They try to outperform the market by carefully watching economic indicators and picking which investments to hold and which to sell. Kind of like a celebrity chef who's always improvising and changing their recipes based on what's trendy or in season. As you can imagine, the fees on actively managed funds tend to be higher.
Passive fund managers are more like chefs who stick to the cookbook. Their goal is to match benchmarks, not beat them. For example, an S&P 500 index fund tries to mirror the modest but steady growth seen in the index of 500 of the biggest companies. Passive funds are popular among investors who believe it's a losing game to try and beat the market. Because there's less analysis and fewer trades, passive funds are cheaper to own.
Mutual funds are an amazing creation. They allow ordinary people to invest like huge institutions, thousands of holdings, diversification, while being easy to use and letting you express your personal tastes and principles. But where do you start?
If you don't have any mutual fund investments yet, you might begin by opening an investment account with a mutual fund company. Their advisors will help you choose funds that are a good fit for your situation. Investors who want a more modern approach are starting to use robo-advisors to invest in mutual funds. Basically, you answer a few questions online and the service automatically constructs a personalized portfolio of funds for you and handles all the trades and holdings. Plus, their investment minimums are pretty low, sometimes just $100.
And if you're invested in a 401k plan through work, you already own mutual funds. And you're paying fees for an advisor, so don't be afraid to contact them and find out which funds you own and what your options are.
Mutual funds make it easy to build a diversified portfolio. When you buy shares in a mutual fund, you are buying into many different assets, stocks and/or bonds, among other assets. The typical mutual fund holds more than 100 different securities, and some hold more than that. Diversification is a key strategy for managing risk, as we'll explore in our next class. Affordability is another advantage of mutual funds. For you to build a large, diverse portfolio by going out and buying all the different stocks or bonds yourself would be much more expensive because of all the transaction fees. Buying shares in a single mutual fund is much less expensive. By purchasing shares of a mutual fund, you benefit from economies of scale. Finally, it's very easy to invest in mutual funds as they are the primary investment option available in retirement savings accounts, such as those available through many employers, like 401ks or 403bs, or those you can set up independently, like IRAs. In the video you watched a moment ago, you learned about the difference between actively and passively managed mutual funds. Index funds are built to mirror a stock or bond index. Because they are passively managed, the index fund basically runs on autopilot, they have a lower expense ratio. Actively managed funds are ones in which people with expertise in financial markets monitor the fund and regularly change the portfolio's makeup to try to capture returns above and beyond what the overall market might provide. Because these funds require significantly more labor to maintain, they have higher expense ratios. I've included this headline to further emphasize the benefits of index funds over actively managed mutual funds. The data showing that actively managed funds do not consistently outperform the market, quote, supports practical advice that has been the academic consensus for decades. Forget about trying to beat the odds and outsmarting everybody else. Instead, use low-cost stock and bond index funds that mirror the overall market and keep them for decades. Don't bother with fads or fancy market timing. End quote. There are many ways you can learn more about mutual funds that you might already own shares of, or ones that you are considering through a workplace retirement plan or a Roth IRA. You can locate the prospectus for each mutual fund offered through a financial institution. This is a lengthy document that lays out the important details of the mutual fund. Know that the prospectus will use quite a bit of legal and financial terminology that may be unfamiliar to someone who is new to investing. The prospectus is an incredibly helpful document, but it might be a bit slow going at first. Another option is a mutual fund fact sheet. Some financial providers now offer these shorter, more user-friendly documents that summarize the most essential information shared in the prospectus. You can find these on the fund provider's website. I've included a sample from Vanguard in the Module 5 materials in Absorb. Another type of financial asset that is increasingly common in retirement savings accounts is an exchange-traded fund, or ETF. ETFs are very similar to mutual funds in that they pool investors' money to purchase a wide variety of financial assets, and so are a great way to diversify your portfolio. Some ETFs are passively managed and track a particular stock or bond index, while others are actively managed. Whether an ETF is actively or passively managed will be reflected in the associated fees, just like we saw with mutual funds. The primary difference between ETFs and mutual funds is how they are bought and sold. Shares of an ETF can be purchased throughout the day on an exchange, much like shares of individual stocks. Investors can place orders to buy or sell shares of mutual funds at any time, but those trades do not execute until the end of the nearest trading day, usually at 4 p.m. Eastern Time. A lengthy discussion of cryptocurrencies like Bitcoin, Ether, and others is outside the scope of this class, but I want to address them briefly because we do get many questions about cryptocurrencies. Beyond buying cryptocurrencies directly, it is possible to purchase shares of cryptocurrency exchange-traded funds through many brokerage firms. From Third Decade's perspective, however, purchasing crypto or funds for which crypto is the primary underlying asset is speculating rather than investing. While there is no precise dividing line between the two activities, what sets them apart is the level of risk. Cryptocurrencies are highly volatile, much more so than the other financial assets we've looked at, and as such encourage the frequent trading behavior we've already discouraged in these classes. Vanguard, an investor-owned brokerage firm, takes a similar view and, as such, does not offer its clients cryptocurrency funds. Andrew Kajeski, head of brokerage and investments at Vanguard, recently explained the firm's decision related to crypto ETFs, saying crypto is, quote, an immature asset class that has little history, no inherent economic value, no cash flow, and can create havoc within a portfolio, end quote. He went on to remark, quote, our products and services are designed with the goal to help investors save more, trade less, and take a long-term approach, not chase trends and churn their portfolios, end quote. You may still choose to allocate some of your portfolio to crypto assets. Just be aware that doing so dramatically increases your risk. If you would like to learn more about cryptocurrencies, please see the optional learning materials in the online classroom. You will recall that one of the principles in the Magnificent Seven is maximize value. We want all Third Decade participants to pay close attention to the fees attached to their investments so they can keep them as low as possible. This graphic from Intentional Money Life illustrates how different expense ratios, or fees on mutual funds or ETFs, can impact an investor's account balance over 40 years. I want to stress that there are mutual funds and ETFs available to investors that charge expense ratios of 0.04%, the lowest expense ratio shown in the graphic. Take a moment to study this data. We are now going to devote some time to showing you how to investigate the fees on investment funds. As you prepare for your discovery meeting, you'll be asked to provide information about the various funds available to you in any employer-sponsored or independent retirement plan you can access. That information will look something like what you see on the screen. The table displayed here is from the University of Arizona Employee Retirement Account information available online. This is a small part of a list of mutual funds available to university faculty and staff in one retirement savings account option, in this case, a 403(b) plan. I've outlined in turquoise a column that provides information on the expense ratios associated with the mutual funds listed. Although the fees indicated here are on the higher side, in terms of transparency, this is ideal. Expense ratio data is very easy to locate through the provider's website. Unfortunately, not all retirement account providers follow this practice. On the next slide, you will see another similar list of mutual funds, this time passively managed funds, with fee data provided, and you'll notice even lower fees. After that, you'll learn about what you can do if locating information on fees is more challenging with your provider. If you discover that information on fees is not readily available to you in a retirement account, there are tools you can turn to for assistance. The Financial Industry Regulatory Authority, or FINRA, offers investors an online resource called Fund Analyzer. You can see a screenshot of the site here. With Fund Analyzer, you can type in the name of a mutual fund or its ticker symbol, and information about the fund, including expenses, will be called up. In the table on the previous slide, the first mutual fund listed in the table was a Vanguard mutual fund that holds both stocks and bonds and is designed for someone retiring in 2050. I typed the ticker symbol for that fund, VFIFX, into the Fund Analyzer, and on the next slide you'll see the results my search produced. Morningstar and Yahoo Finance are other online resources that you can turn to in your search for information on fees attached to mutual funds. As you can see, the Fund Analyzer report matches what we saw on the Vanguard website. This is a very low expense ratio. A good benchmark for you is to look for mutual funds and ETFs with expense ratios below 0.25%. We want you to practice using FINRA's Fund Analyzer tool. Choose one of the mutual funds from Fidelity or one of the ETFs from Charles Schwab listed below. Write down the 4 or 5-letter ticker symbol. On the next slide, you will visit the Fund Analyzer website and use that ticker symbol to discover information about the fund. Pay particular attention to the fund's expense ratio. Here is the expense ratio data for all 4 funds. Notice that the range of expense ratios is fairly large, from as little as 0.015% to as high as 0.82%. Your financial mentor can work with you to locate low-cost investment funds suited to your goals. Think back to the activity you completed earlier in this class when you rated different financial assets on return, risk, and costs using a 1 to 5 scale. Better yet, pull up the photo you took of your predictions. What would you add to or change in the table now that you know a bit more? Here's the solution to the task you completed earlier. Think about your initial predictions and what you learned over this portion of class. Do you find anything in the table surprising? Note that for the most part there's a strong correlation between risk and rate of return. Notice also that there is a wide range in the rating for mutual funds in the 3 categories. This is because rate of return and risk depend on the assets included in the fund. A bond fund, for example, would be closer to a 2 or 3 on rate of return and risk, while a stock fund would be a 3 or 4 in those categories. The costs of a mutual fund vary based on whether it is actively or passively managed. This class is most connected to maximize value and pass it on. Being aware of and vigilant about the fees associated with the financial assets in your investing portfolio can help you maximize value. Many investors are paying higher fees than they realize when they invest. We hope you can pass on what you've learned to help others in your life minimize their investing costs as well. Take a moment to reflect on the learning goals for this class. How confident do you feel about your ability to do all of the things listed on this slide?